RBI policy. So broadly, when we were approaching the policy, most of the market participants were of the view that RBI will cut the policy rate by 25 basis to 6% as inflation continues to be quite comfortable. Growth is probably losing its momentum. One of the differential points in the market participants' view was that how will really RBI tackle its stance? Given that RBI had already injected 5 lakh crores of permanent liquidity in the system since last 2 months, there was a camp which was expecting RBI to change the stance to accommodative, which would have meant probably that liquidity will continue to be surplus. Your overnight rates will continue to be lower than probably policy rates. Um, until the time RBI will keep it surplus, at least till the time RBI wanted to ensure monetary policy transmission and wanted to keep financial conditions easy. There was another camp in the market which believed that given that global economy is going through volatile times, currencies are going through volatile times, it will be probably more prudent for RBI to keep the monetary policy stance at neutral, which may give RBI more flexibility to respond on the other side as well, both on liquidity or rates, if tomorrow global financial conditions get very volatile. But having said that, RBI, while it acknowledged, the impact of global economic policy uncertainties on growth as well as on inflation, it not only changed the stance, but it also changed the paradigm of the stance. So typically, what market participants have associated the stance of accommodative is one that yes, the next move is probably a cut or a hold, but what also means is that liquidity management will be easier and RBI will keep liquidity easy. So RBI very explicitly in their press conference differentiated between the stance and liquidity management. They explicitly mentioned that they will keep liquidity at surplus of 0.5 to 1% of NDTL. Given that NDTL is in excess of 200 lakh crores, it means that they will let liquidity be somewhere between 1 lakh to 2 lakh crores of positive, and which means that overnight rates could be lower than policy rates. The second big change was that they said that how they are interpreting the accommodative stance is that they want to keep rates lower to support growth. What that really means is, and what is more even constructive for the market, is that they are likely to keep rates lower and in fact cut them further to ensure that they support growth. And why do we feel that? So if you look at the second table on the right hand side, which is RBI estimates for real GDP growth, largely if you see RBI is expecting 6.5% growth for FY26 compared to 6.7 in February 2025, and it's just a 20 basis downward movement due to global uncertainty. But we would say that the impact of global uncertainty or this tariffs will not just be on India's immediate exports. It will also be on the investment sentiment. It will also be on the hiring sentiment. It will also be on the consumption sentiment. So probably, at some point of time, even these growth estimates could get revised downwards. What that would mean is probably, the second comforting part is RBI is also expecting inflation to be lower at 4% for FY26. So in nutshell, what we mean is if we are expecting lower growth and inflation close to RBI's target of 4%, RBI can easily cut rates by 50 basis points from current level. That is, we expect RBI to cut repo rate to 5.5% in this monetary policy cycle, given that they are quite comfortable on inflation and they do expect growth to slow down from here on. Secondly, given that we are looking at a easy liquidity, that is also very constructive for shorter end of the yield curve, which should keep rates at the short to medium end quite anchored. So broadly, if we look at the inflation trajectory, RBI is quite constructive on, like we saw in the last table also, on the inflation trajectory as one of the major determinants of inflation in the last 24 months has been, food inflation, and especially the volatility in vegetable prices. As that has now come down, there has been abundant arrival of vegetables in the food market, and we are seeing this slowdown in inflation, and that's why probably RBI expects inflation to remain well controlled during FY26. If we look at the CPI diffusion index also, and we look at constituents which are greater than 5% inflation, that continues to be quite stable, shows that inflation is not really broad based, but a very few items of uh, inflation really driving it. As they slow down, they stabilize, we do expect inflation to remain quite.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.